Hello, listeners. Welcome to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. Joining me for our weekly chat is Rob Larity, our chief investment officer. I'm recording on Wednesday, October 11th. So usually we do this the day before. This is 2 days before because I'm in Boston traveling. Also, hope you're not getting sick of my voice. Ton of content this week because of the things that are happening in the world. We also have a lot of new listeners from some of the interest of the events of this week. We're glad to have you here. If you want to write to me or give me suggestions about the podcast, I read all the emails that come in and I try to answer all of them. My email address is jacob@cognitive.investments. And if you want to do us a solid, please leave us a rating or a review on Apple or wherever you're listening to this podcast. It takes 2 seconds of your time, really helps us and allows us to keep doing what we're doing without having to charge for the podcast. Otherwise, if you have questions, comments about CI's wealth management services, our research and consulting services, anything like that, you have my email address. Take care of each other. Hug the people you love. See you out there. All right, in a role reversal, I'm here in Boston. Rob is in Paris. Nobody's in New Orleans. How's it going, Rob?
I was going to say I'm jealous of you, but I'm quite happy where I am, so I can't really say that.
Yeah, why would you be jealous of me in Boston? I mean, it's pretty nice in terms of Boston weather standards, at least so far. So,
well, you get to hang out with all the team.
Yeah, but I'm an introvert. I'd rather hang out by myself in my basketball shorts in my office. You know that. Anyway, we're going to use this weekly podcast to check in on all the things that have been crowded out by the Israeli-Palestinian war. So we've been pumping content out this week on that. There is more content to come. I promise you on that, and you'll hear from me solo if things really get crazy as usual. But we're going to try, it's as hard as it is, to not touch that topic because there actually is a lot going on in the world aside from the focus on the Israeli-Palestinian conflict. I'd also just throw there's a lot going on in the world that is violent and terrible too. I mean, the Sudanese civil war is at roughly 9,000 people dead. Ethiopia is having maybe another civil war with the Amharas. Who knows? Like, if you start looking around the world, like, there's a lot of terrible things going on. Just it hasn't captured the attention of the world, and I think that's especially true also when we're talking about political developments, macro developments, financial developments. It's very hard to stay attuned to what's going on when other things are happening that are sucking up the oxygen. So we're going to try and give you, though, what have you been missing while everything else has been at the front of the headlines. And in this sense, Rob, I'm gonna sort of light our way through the dark, but you're the one who's going to help us figure that out because I've had my nose sort of in the weeds of some of these bigger things that are going on. But the first thing we talked about when we were prepping for the podcast this morning was about what's going on with Treasury bonds and sort of the sell-off there. I sent you an interview last night that Paul Tudor Jones did. You were aghast. I don't know if you remember this, like 12 months ago or something. You asked me you said something about Paul Tudor Jones, and I said, "Who's Paul Tudor Jones?" And you face palmed and you were like, "I can't believe I actually agreed to work with you, you moron. You need to go figure out who all these people are." Anyway, so I've been doing my homework. I got a little Google alert that he did an interview on CNBC. And the first thing he said was that geopolitical uncertainty was affecting the market. So felt good about that. But he spent the rest of the interview talking about U.S. debt and about how within a year or two, U.S. interest on debt was going to be more than, I forget exactly, had something to do with the and he was talking about debt, and he was really afraid about debt and the U.S. fiscal situation and how it was a terrible time to own U.S. equities because of the U.S. fiscal situation, sort of backing into the Treasury market from that way. So that's my way of setting you up to talk about the Treasury bond sell-off and how we're thinking about it, and specifically how you're thinking about it, and maybe why some of the doom and gloom is unwarranted.
Well, first of all, Paul Tudor Jones is from New Orleans. I don't know if you realize that. So double shame on you.
I could tell he was from this. I'm not from New Orleans. I don't know. He sounded like a Southerner, not a New Orleanian to me. But okay, yes. Shame taken. Humble pie acquired.
It's funny to see hedge fund managers, and especially very famous and long-standing ones, doing interviews on television, because I always say, "Oh, I'm talking my book," as you know. They talk their book, but they don't give the disclaimer. So you always have to take these statements with a grain of salt. And also, I think there's a tendency amongst that group to overplay some of the doom and gloom stuff, in part because there's sort of a strand of thinking about, the world's going to hell in a handbasket, and that's pretty common. So with that said, I think what I would say tangibly, because you've seen this, not just Paul Tudor Jones, this is a meme or a narrative that's starting to emerge, especially around the government shutdown talks and all the political developments that we've seen in the last few weeks, is this notion of, is the U.S. getting out of control? Is government debt getting out of control? Are we sort of galloping toward a hyperinflationary scenario? And one of the key things that the term that everyone seems to be talking about in the last week or so, at least that I've heard, is term premiums, which is, maybe this is too far into the financial media weeds and the Bloomberg terminal kind of stuff. But I've seen more reference to the word term premium in the last week than I've seen in like the last 10 years. And basically what that means is, I'll try to explain it as simply as possible for those listeners who don't know. If you think of the bond market, and it has different durations going out, there's 10-year bonds, there's 5-year treasury bonds, all different lengths. We know what the market expects interest rates to be at any given point in the future. Like what the market thinks the Fed rate will be, the overnight rate 2 years from now, that's priced into interest rate markets. So you have this curve of interest rates going off into the future. The term premium is simply the difference between what are the actual long-term bonds and the rate that is implied by that curve. So, for example, if the 5-year treasury bond is trading at 4%, and if and that is 100 basis points higher than the aggregate of all the short-term interest rates between now and 5 years from now, then the term premium is 100 basis points. So that's a really wonky explanation, but it's basically like a measure of fear, a measure of how much people want to be compensated for not knowing if 5 years from now we're going to be, a banana republic, and all the unknowns are going to jump out of the closet. So that narrative is growing, and I think it's worth addressing because we do get a lot of calls from clients about this all the time. About the dollar and about fiscal unsustainability. And I guess the only big thing I would point out is, if you really look long term, we have so far to go before we see real fear. And you can measure that quantitatively because, ironically, in the Bloomberg article that was, telling this narrative, basically saying, oh my God, people are really getting afraid, and look at these term premiums. They show a chart of the term premiums and they go back 3 years, and the term premiums on that time frame, oh wow, they've really skyrocketed. They were negative for most of that 3-year period. So people were paying a premium over what the interest rate markets were saying. But if you zoom out and you can actually click, ironically, on the Bloomberg article itself and bring up the underlying chart, and you take the time horizon and extend it out beyond the last 3 years, we're barely even getting going. So right now, the term premium on 10-year bonds is like 25 basis points. And even in the middle of the mid to late 90s, when, as the Matrix points out, it was the peak of American civilization, as some people like to think, and things were great. Even in the middle to late 90s, during that period, term premiums were 100 basis points to 200 basis points. So, and never mind in the 80s and periods of greater stress. So I think we're so used to complacency in bond markets, we're so used to those term premiums being negative, that we're looking at this small change and saying, oh my God, there's really starting to be panic out there. We're a long way from that, which isn't to say that the fundamentals aren't moving in that direction, but I think you have to take that time horizon. Like you often say geopolitically, these are the good years. These are the Belle Epoque years before you get into the real nastiness. And I think that's what the consensus is missing, is we have a long way to go before we really see fireworks.
Yeah, I'll play the devil's advocate here. And I think the part about this that is, well, actually, before I play the devil's advocate, I do have the sense that, as you said, when these guys go on and talk their book in these interviews, they're older, they're successful, they have embraced conservatism with a small c that comes with, once you have acquired a bunch of wealth, conserving it and thinking in that sort of way. I doubt when they were young guns, like fresh out of school or wherever they were coming from, and they were trying to make a name for themselves, that they were talking about this sort of stuff. And I'm sure that the people who were successful then were talking about this kind of stuff. Look at Pierpont Morgan versus JP Morgan versus what JP Morgan is today. So I think there is something in that too, that those are the people that get to say that. But the real opportunity is underneath the surface, even if maybe at the top it's a little uncomfortable. But the devil's advocate pushback would be, and I'm stealing from his argument here, is if you extrapolate, U.S. government expenses going forward, and you look at our political situation, it doesn't matter whether you're a Democrat or a Republican, or you vote for Biden or for Trump, both of them have massively increased government spending, seem unwilling to raise taxes in any meaningful way, and don't want to cut entitlements. So if you're going to continue to spend $800 billion a year on defense, and you're not going to cut any entitlements, and you're going to keep tax rates relatively low relative to most of the rest of the world, like, that number is just going to keep getting bigger and bigger over time. And there seems to be no candidate, no political party that is willing to say, hey, if we do this for the next 5 to 10 years, like, we're going to have a problem. That's not even part of the discourse. So does that concern you at all? Do you feel like that could, maybe that's accounting for the doom and gloom narrative, and maybe your response will be, all right, like, when the fireworks come, like, we will figure it out. That's usually how the U.S. works. We're impeccably bad at planning for problems. Problems arise, and then we deal with them in a crisis moment, and then we move forward. But how do you respond to that sort of political pushback to the rosier picture that you're painting?
I think the key word that you just used was extrapolate. That's the problem, is you're taking a linear view and saying, well, if you continue along this linear path, then that's where you eventually end up. And that's not a framework that's going to work, because there's cause and effect. And we have a political system that responds to incentives, even if it's too little, too late. But if you look at historical periods of hyperinflation, they've almost always been associated with some sort of significant societal trauma. From an economic standpoint, they usually are associated with major supply constraints or supply destruction, like literally factories being blown up, people being killed in wars, like, being unable to produce things. I would take the fact that there's no obvious will to change any entitlements or to cut the defense budget or even to streamline the defense budget as a sign that how early we are, because there's not even enough of an incentive out there for the political class to respond. We had the first little surge of inflation in living memory, and we passed the Inflation Reduction Act, and that was the signature. Of course, it wasn't designed to fight inflation, but the point being, a little flash in the pan, and people start to panic. Like, what if you really start to have significant problems? I guess that's what I would say is, like, we don't know what volatility looks like because it's been so long. We're so complacent, and you can't take that linear approach from today to very far from today without taking that into account, if that makes sense.
It does. And not to pick on him too much, I mentioned that he talked about geopolitics in his first sentence, but he kind of skated over it because he was like, oh yeah, but the market has gotten used to geopolitical instability. And I was like, my man, like, no, that's not the right conclusion. The right conclusion is I need to be listening to Jacob's podcast all the time because geopolitics is going to fuck up my shit all the time. Anyway, so if Paul Tudor Jones is listening, pardon my French, and you should pay more attention to geopolitics, Paul, seriously, New Orleans guy. Anything else you want to say about the bond market before we move on?
No, let's hit the global stage here because there's a lot going on, I suppose.
Well, I think the next one to hit with is usually China is crowding out, is the elephant in the room that is crowding out a lot of the other headlines. And it's funny, we had we had some data in August that Chinese maybe green shoots in the economy, maybe services going up a little bit, like consumer prices go. It looked like maybe there was going to be a reprieve. Nope, that all stopped in its tracks. September's data doesn't look particularly good, and there's a lot of other sort of things happening in the property developers market, local government debt, which is a drum that we have been banging here since the beginning of the year. China Beige Book, which is a great resource for those who are out there, are also anecdotally showing that things are not going so well. So why don't we check in on China and where Xi Jinping is out on his treadmill, and what the incline level is and how fast the treadmill is going.
Well, this is a good example because often we talk about the importance of what do you pay attention to. And this is a great week for that because everyone is paying attention to what's happening in Israel and the Gaza Strip. And in the meantime, there's been some very interesting developments in China and very worrying developments. So I will pat us on the back here in part because we were here a little over a year from now when we did that podcast on the Chinese property market and said, hey, the consensus is really underestimating how important and how huge this problem is. And since then, and just to, put concrete stuff around that, we have been out of Chinese equities in our strategies, our global strategies for clients, which are supposed to sort of be benchmarked and outperform a passive international index. Well, China is by far the biggest component of any passive international index. And it's been a terrible place to have any money for the last year. And thankfully, our clients have benefited from not being in there and being in a place like Japan, which now everyone loves. I've seen so many articles in the last week about Japan and how it's the place to be, and Warren Buffett, the guru, strikes again.
We joked about that when all that, it really was like Buffett decided to buy Japanese companies and then everybody and their mom, like it's almost skewing the data so much that I don't even know what to think. Anyway, but go on.
Anyway, we wanted to talk about China, but yeah, that's just kind of to self-congratulate us on, how these things actually matter as far as dollars and cents go. But where are we now? So the consensus on China has been very bad. I still think that people underestimate the scale and the importance of this property market issue. It is the biggest issue in the world, full stop, from an economic, a market, a structural long-term standpoint. But that said, the sentiment toward China is really bad, and some things in the last week or two have emerged to really suggest that that's accelerating. And that's two data points, I think, of particular interest. The first is we're sort of having a final reckoning with the property developers. So Evergrande, Country Garden, they're essentially, acknowledging the scale of their bad debts and acknowledging their defaults. Now, the issue here is not so much their bond exposure. The issue is their payables. So just accounts payable not to financial investors and mutual funds and people like that, but to providers of construction materials and construction subcontractors and people in China who are, running real businesses and doing real things. Evergrande itself has $82 billion in payables just to construction materials companies, is the number that I saw. That's extraordinary. So some of these issues, and they will be worked out, there's liquidity that you can throw at these things. These are liquidity issues, and China has shown that there's no lack of will to smooth liquidity issues over. But that's really coming to a head. The other data point was there was a piece, I think it was in the South China Morning Post, pointing out that local governments, especially in the north of China, which has been hit particularly hard from a macro standpoint, that they're borrowing money in order to recapitalize local banks. And that is a very interesting and worrying development because it shows, A, that they're acknowledging the scale of the problem and that they're running out of liquidity. If they need to recapitalize them, it means that they need that liquidity. and B, the fact that local governments are taking out additional debt, to rob Peter to pay Paul, essentially suggests that there's a growing problem there. So this isn't to say that there's any financial crisis. I don't think there's going to be a financial crisis in the way that we think about it, but it shows, as Walter Baggett said, the scale of wealth that was destroyed in the boom. The crisis just reveals how much of that is already poof, gone away. And now we're having a bit of a poof moment, and it's not good as far as directionally how China goes.
Well, and it's especially not good for the arguments about the commodity super cycle that have been so prevalent in the last couple of years. Because talking about extrapolating, I think that was a case of extrapolating all this demand for renewable energy and all the mineral commodities that you're going to need. Plus, of course, China is going to continue to consume at this level. And the dirty little secret is that China consumed at this level and really, in some ways, floated the global economy by building these ghost cities in the middle of nowhere and taking the commodities to build them. Like the rest of the world enjoyed benefits from that too. Now that China's trying to say, well, we can't do that anymore, and these companies are bankrupt and things like that, suddenly the demand for some of these commodities is going to go down, I think. But I wanted to ask you, the South China Morning Post story. I mean, we do this stuff for a living. Can you, for in a layman's terms, describe what it means when a local government is borrowing to recapitalize a local bank? Like, what does that mean in practice? Because there's a lot of jargon just in that sentence, and I know that there's a lot in there. So let's just maybe in clearer English for somebody who's not focused on markets, explain exactly what that means.
So I'll try to explain it as simply as possible. Capital is essentially the equity on a bank's balance sheet that's available to absorb losses. And in the end, it doesn't matter that much. Capital is there to basically be an accounting entity. If a bank takes a big loss and it doesn't have enough equity to absorb the loss, then the bank is sitting it's insolvent. Its liabilities are greater than its assets, in other words. That doesn't necessarily mean that the bank's gonna go bankrupt. Banks go bankrupt because they run out of liquidity, not because they're insolvent. So when I say it's interesting that they're borrowing money to recapitalize the banks, to basically put equity into their own local banks, it might suggest that not that they're so concerned about solvency, which is a balance sheet issue, that they're concerned about liquidity and giving them additional liquidity, which is a cash flow issue. I know I'm falling into lingo despite myself, but it's a very complex subject to explain in very simple terms.
Don't worry, I'm going to beat the lingo out of you. I thought capital on the balance sheet, according to the SBF theory of management, was that that's money that you use to gamble on cryptocurrency. That's not why the banks have capital in the market. Anyway, I cannot get enough SBF, but we don't have to go down that rabbit hole.
Well, but SBF went under because he ran out of liquidity, not because he was insolvent.
Yeah, I was. So Michael Lewis wrote a book about SBF, and I was watching one of the interviews. Another New Orleanian, apparently New Orleans just rules the world. And it was funny. He had this line that I thought was very strange. He was like, "Yeah, if they hadn't had a run on the bank, basically, or if they hadn't had a run on the exchange, probably FTX would have been fine. They probably would have paid back all the liabilities, and nobody would have known, and they would have kept minting money." And I wanted to be like, but they were taking anyway. It was just a weird justification of the it was still a Ponzi scheme, Michael. Maybe it wasn't a Madoff Ponzi scheme, but it was still fraudulent, and eventually the casino was going to blow up. Anyway, but to go back to beating the lingo out of you, okay. But so here's another part of it that maybe we need to talk about in plain English. So it's local governments borrowing to recapital local banks. Who do you borrow from if not the local bank? So who's the bank that you borrow from if you're trying to stand up kind of the local, is that they're going to the People's Bank of China, and so eventually all these local banks are just going to be on the People's Bank of China's balance sheet, and then one day we're going to go poof and it's all going to be one bank? How do you fit that into the equation?
Well, I don't know specifically who is buying these local government bonds that are then being, taking the money and in turn giving it to the banks, but I would assume that it's the shadow banking system, which is these essentially local government financing vehicles, they call them, which are special entities that get set up, and they borrow money through wealth management products. So ultimately, the people who buy the wealth management products are ordinary Chinese households, and they get marketed to them as, hey, we're going to pay you 8-9%. There's very low risk. Ultimately, the People's Bank of China is going to stand behind everything. This is a great deal. And that has been the biggest source of capital or borrowing within the financial system in China. So that's the thing to remember, is all of this bullshit at the end of the day, all the lingo, all of the, complex financial mumbo jumbo, it's ordinary people who have their wealth confiscated to pay for all this. Like, that's the bottom line. Like, that's how it goes. It's how it always has gone. Wealth is not just numbers on a paper and accounting entities. It's real stuff in the real world. And the people who have it are the ones who get screwed when wealth gets destroyed through bad lending and bad investments. So those are the people, ultimately standing on the other end of this. But yeah, that's the mechanism through which they usually finance these things.
Well, so it is kind of the SBF School of Money Management. All right, well, here's another simplistic, not simplistic, but the geopolitics guy is taking advantage of the markets guy and asking him tough questions. What is to stop China from using its massive pile of foreign exchange reserves and just hitting the reset button on the entire thing? Like wiping out the liabilities. Like they have what? I forget what their current account surplus is, but it's in the trillions of dollars. Is the problem beyond the ability of the Chinese government to take $1 trillion and just put the Band-Aid on and debt jubilee and we go from there? Why? Tell me why that's a stupid idea and that I haven't done enough reading on economics.
It's not a stupid idea, but those aren't just assets sitting in a bank account. That's not their kitty of U.S. Treasuries. For every U.S. Treasury asset that they have a yuan liability on the other side of it. So that's not like the savings account of the PBOC, and it's just, oh, well, should I dip into the savings to bail everyone out? It doesn't work that way. There's two sides of the ledger. Now, which that isn't to say that China can't use those treasuries to support the renminbi. That they can do. That's the function of foreign reserves. And originally that's why, China and a lot of countries like it, following the Asian financial crisis in the late 1990s, started accumulating such enormous reserves because, it started out that they were worried that they were going to see a sudden stop and a drop in their currencies, which is what happened in Asia in the late 90s. So yeah, it protects you against unwanted currency depreciation or unwanted currency risk, but it doesn't change the underlying reality of wealth destruction and who's paying the bill. That's not wealth that can be tapped to pay for these losses, if that makes sense.
It does make sense. And I wonder, on our investment research chat this week, you were actually talking about gold, and I wonder if that has something to do here too, because the People's Bank of China has been loading up the dump truck for gold. They added 23 tons in July alone. They were the largest buyer of gold in the world from a national perspective there. Do you think that has anything to do kind of with what we're talking about? Because you're talking about foreign exchange reserves as protection against these things, and I don't know, that just stuck out to me as kind of interesting in that context too.
So let's talk about gold a little bit, because this is something I've been thinking about, and we should go down this path. I think everyone, when they talk about gold, because it's easier to think in this way, thinks in terms of central banks, and cites those numbers and, oh, Russia's doing this or China's doing this. At the end of the day, I don't think that's going to make or break the gold market. I think, yes, at the margin, central banks are buying some more gold. Ultimately, they can't hold too large a proportion of their foreign currency reserves in gold because, there's a very strong preference for U.S. Treasuries or for U.S. denominated liquid assets. That's the biggest, by far, most liquid and deepest market in the world to park your foreign exchange. I just don't think the central bank thing is that big a deal. The big deal, I think, which is harder to measure and harder to really get the pulse of, is individuals with wealth who are putting their money in gold. So take the China example. I think, this is something that everyone talks about, and I don't want to start like a weird cuckoo gold bug discussion here, because that doesn't do anybody any good, and you can get that on plenty of other podcasts. But it's worth thinking about this sort of analytically in the sense of, like, where are we in the environment right now? And one of the things that's pretty clear, even as we look around us, we talk about, the U.S. defense budget and fears of fiscal prodigality. You go into cycles of overspending and then wealth confiscation. And wealth confiscation can have a lot of different forms. It can be, stealth monetization of the debt. It can be just outright raising taxes on stuff. So, for example, like after World War I, like what happened to the English country house? It stopped being a thing in many ways because the taxes on real estate in England went through the roof. And all of these, I know I always forget the name of the show every time we talk about it.
I was gonna say you've been watching too much Downton Abbey. That's what you've been doing
exactly.
in your spare time.
Remember
on the
in Downton Abbey when they had to downsize and all the servants left? Like, that is a story about taxation and about fiscal prodigality.
Well, we had one listener actually write a comment on Apple on the podcast saying, I want Jacob's views on Downton Abbey. Let's just say that before it got to that point in Downton Abbey, I got so pissed off that I stopped watching. But the first couple of seasons, really, really good. Anyway, keep going.
So you missed the sad part at the end when the world went into the 20s and But
Rob, that's my life's mission is trying to miss the sad part. That's what I'm trying to do here in general.
Yeah. Well, I think globally, we're sort of seeing a bit of the sad part, or we likely will in many ways, because that's the natural outcome of these cycles, and that's what we saw back then. And in whatever form that takes, and in different countries, it's going to take different forms. But someone has to pay the bill for bad debt and wealth destruction. So that, I think, is a very interesting trend. And especially it's a self-fulfilling one, because as people begin to worry more, then, they start to look for ways to protect their wealth from being confiscated. And gold, I think, is a very attractive asset in that environment. Land is very tricky. Land can be seized. If you know anything about history, the whole history of Western Europe is people getting their land seized and given to other people, in various forms. So having something that's movable, something that is relatively liquid, and also, as a side effect, there are increased reporting requirements globally now. So like everyone has this vision of, the Swiss secret bank account. Like, that doesn't exist anymore. That's been totally stomped out, in the last 15 years through FATCA and all of these new regulations that have been put in place. It's not like the Wolf of Wall Street days when people would just roll in with suitcases full of cash, and those days are long gone. But the one exception to a lot of the new rules that have been in place is people who own property or people who own gold that doesn't throw off any income. In many jurisdictions, you don't have to disclose the ownership of those assets, or at least not to the same extent as you do, if you own cash or something else. So there's sort of structural advantages or structural reasons why people who have wealth, who are concerned about getting the wealth taken away by governments, might increasingly turn to gold as an option.
Yeah. There's a Bob Menendez joke in here somewhere, but for the second time on the podcast this week, I can't quite find the joke itself. But, Bob Menendez had some gold bars in his home, I guess precisely because it was untrackable. And it's funny also to think about how people talk about gold and things like cryptocurrency doing the same thing, whereas like the thing about gold is it isn't really trackable, whereas cryptocurrency is eminently trackable, which has always seemed like a bit of a discrepancy to me. But I mean, working back from that and sort of getting back to the China point, I think it's also a good segue to talk about kind of emerging market economies in general. So, I mean, the reason that I'm here in Boston, we're recording on Wednesday, October 11th, so a day earlier than normal, and this will go out on Friday at our normal time. But I'm here to talk to a group of Chilean executives and talk about how geopolitics is affecting Chile and what strategies companies should use to get through these geopolitical risks and opportunities. And maybe if there's some Chilean government officials there, they'll learn some things from it as well. But the reason I bring it up is because we were also talking before we hit the record button that China has given a blueprint for success that really no other country can follow. That because of China's success over the last 30 years, everybody wants to be the next China. And even, some of the things that are actually examples of the problems, the structural problems in China's economy have become things that people want. People want the current account surplus. So they want the massive batch of exchange reserves. And, Chile is a country, I think, when you start looking at they've had a current account deficit. They had a brief, actually, month of surplus here recently, which I'm going to have to dig into a little bit. But, mostly a current account deficit. Investment, like relative to GDP, is relatively high, and foreign direct investment has been increasing. So, like, Chile has a lot of the fundamentals that we look for in a country. And I'm going to talk to this audience and say, like, yes, you have all these problems, but look at your geography and look at your energy security and look at your food security and look at all these other good things that are happening to you. Now look at the fact that you trade only with the United States and China, and you really need to broaden and diversify your base if you don't want to get screwed. But this is a way of setting you up for, I know that there was an article in the FT about Turkey this week that really got you going. So maybe use that to segue into Turkey in general. Turkey, another country, by the way, loves their gold and has a lot of gold in the foreign exchange reserve. So it's not a perfect segue, but it's pretty good. Get on your soapbox about Turkey.
Follow my soapbox. People don't want to hear that. So this FT piece really got my goat. And I think the issue is that we've been so blinded by China's success as far as, thinking that is the blueprint for every emerging market economy. And aside from the FT, there was a piece incidentally on Brazil in The Economist last week that was just like the orthodox, they're prematurely deindustrializing, they don't manufacture enough, like, just why can't they be more like China was essentially the thing. And as you know, Brazil is just going from strength to strength. So the fact that the Economist is writing these sort of whiny, complaints just, I think, totally misses the point. But on the Turkey thing, and this is relevant because Turkey is so central to everything going on in so many ways right now, the gist of this FT article was a very orthodox one. And it's funny how moralistic we are in these ways because, the article was essentially saying, well, they've been running the economy into the ground with these crazy or unorthodox policies. And after the election, they got, held to account. But how long will their come to Jesus moment really last? And will he lapse and start cutting interest rates again? And so on and so forth. And I started saying before that I think we're really blinded by the Chinese experience. And what I mean by that is Turkey looks in many ways like what a successful, emerging, and fast-growing catch-up economy should look like. They have a big current account deficit. They've always had a big current account deficit. That is what you want to see in a successful developing country. It means that capital from richer places is going into this place that has less capital, and it's investing in the country. So, you have to remember the current account is the opposite of the investment account. So if you're getting more investment in from the outside, by definition, you have a current account deficit. So Turkey is very orthodox in that way. We're just so used to thinking of China as the orthodox thing, but China is really the very weird outlier. And if you were to look historically at other developing countries that were successful, they look more like Turkey and less like China. So that's one point I would make. And if you look at Turkey, the FT is talking about, the inflation is so high, and and debt. They've gone on a quote borrowing binge to support these unsustainable, unorthodox policies, and the data just doesn't support that at all. So the currency has been going down. That's like the escape valve of the Turkish model. The Turkish currency has been going down for literally 220 years. Like since the Napoleonic Wars, it's been successfully just lower, 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 lower. Oh, we'll peg it to gold for a while. Now it's lower. We'll peg it to the dollar. Now it's lower. Like that's just how that system works. And in the interim, Turkey's gone from being an extremely poor, backward place to a middle income and growing nation. If you were to look at their share of global GDP, for example, it's doubled in the last 20 years. So their market share of the world has doubled, which is pretty extraordinary for a place that's supposedly such a basket case, right? So what else would you expect to see if this was this crazy, binge of debt-fueled extravaganza? You would expect to see debt levels be very high relative to GDP. They're not. Government debt is in the 30% range, which is super low relative to even other emerging economies. And private debt is 180 something percent, which sounds like a lot, but that's very much on the low side of the global scene. So Turkey, I see here 184%. Germany is 181%. Australia 180%. Spain 190%. So if you're sandwiched between Germany and Spain, then you're not a basket case banana republic. I think it's fair to say. And the last point I would make is just, if you look at, Turkey, the debt is not going up, which shows you that the investment that they're making through the current account deficit is productive investment, is resulting in GDP growth. And you can see that because the investment percentage of GDP is super high. It's in the 30% range, which if you take away China, which is in the mid 40s, and that's just a crazy outlier for reasons we've discussed in the past, that's very much at the high end of the range within that group of countries. So I don't think you could look at any of the actual data on Turkey or just do a thumb to the wind check over a 20 or 30 year period and say that they've been anything but a huge success, despite inflation, which has been consistently volatile and every 10 years or so goes into the 20s or 30s. So anyway, that's my soapbox. I think people really misunderstand not just Turkey, but emerging nations in general, and they misunderstand it for moralistic sort of reasons, and also because China has made us think in a very weird way of what a successful emerging country should look like.
Well, first of all, I invite those people to continue misunderstanding it, because that's good for our business in general. And second, if you are interested in international investing, not just buying ETFs from BlackRock that are 30% one stock that doesn't have anything to do with the country, you know where to find us. Shameless plug right there. The one thing I would say is, in the mid 2010s, Turkey did have a problem with debt. It wasn't that the overall percentages were that big, but a lot of it was dollar denominated. And as you said, as the Turkish lira started going down, it wasn't the debt levels were necessarily increasing in absolute terms, but because the debt was denominated in dollars and the Turkish currency was going down, that was what led to that first initial collapse of the Turkish currency in 2018, and the Argentine peso went with it, and a couple other currencies around the world. And they stabilized things, and then we went through periods of the Turkish currency is getting weaker and weaker. And this was the time where everybody thought Erdogan was crazy. And we were here saying, no, what he's trying to do on the fly, and it could blow up in his face, but what he's trying to do is get away from some of this dollar-denominated debt and get it in liras. And that's why he's backstopping so much of this with the lira and trying to get people and companies to put more of their assets into Turkish lira rather than to US dollars. And it hasn't been perfect, and they haven't solved the issue entirely, but they've made significant progress since 2018 in doing that, and with the Turkish government pushing for that. The other thing, and I said this to you, was the thing that Turkey has in the background too, is that, and maybe Erdogan knew this, so this is why he felt comfortable, dwindling the foreign exchange reserves down and doing what he did to defend the currency and keeping up quote unquote unorthodox monetary policies for as long as he did, was the Gulf came in and bailed him out. the UAE bailed him out and the Saudis bailed him out, and he seems to have enough political goodwill that he can call up the Gulf and say when he needs the money, like the money is there and it's okay. Whereas like if you're, I mean, Argentina is sort of its own separate question, but nobody's going to come to Argentina's aid anymore because they're not willing to do it. Like the Gulf is willing to pony up for Turkey, probably for geopolitical reasons more than anything else. So, but that's still good policy. If you know that you have that in your back pocket, why not use it? And why not reduce your US dollar denominated debt exposure there too? So I wouldn't say Erdogan is crazy, and that definitely could have blown up in his face, but it didn't. And I think the point that you're making here is that the story on Turkey, it's the story of 2018. It's not he pulled it off. Like he actually got through the other side, and he's still the leader of the country. And now Turkey is going through a growth cycle with policymakers who are just as orthodox and who genuflect at the altar of the economists themselves. They probably see them in all the meetings. Like those are the people running the Turkish economy now. So I take your point there too. Anything else you want to say on Turkey before we hit our last topic?
Well, just on the injections that they've received or the liquidity that they've received from the Gulf, I think it gets back to what we talked about with China before, which is that's not wealth that they need. That's not capital that Turkey needs. Turkey's not insolvent. Turkey needed dollar-denominated currency to defend the lira. So those are different things. And like I said, that's sort of the escape valve of the Turkish system, is like the lira kind of has to always go down, but you can't have it go down too fast or too recklessly because that causes volatility and social problems and stuff like that. And I think you mentioned Argentina. That's a wonderful comparison, because if you look historically, like Argentina has similar problems with currency, obviously. And they have been a country that's run, kind of swung between deficits and current account surpluses. But if you were to look at just their current account, you would say, oh, well, they're better than Turkey if you were, thought of it in those ways. And Argentina has gone absolutely nowhere for, 100, it depends on how far back you want to go, at least 100 years. So though, like on the surface, you would say, oh, Argentina and Turkey, high inflation, current account deficits, those are two completely different scenarios, completely different economies. And one is sort of firing on all pistons in some ways, and the other one is just a basket case or a dumpster fire, as I think is the metaphor you prefer usually for Argentina.
Oh, it's the technical term, not the metaphor. That's actually what it is.
Is that in the IMF report?
No, I Chicago Manual of Monetary Policy or something like that. That's a really, really niche joke that I made just there. Let's close with some thoughts on energy. For the second time this year, I ventured to say publicly that I wasn't sure that oil prices were going to go up in response to a big external event. So earlier this year, it was the initial Saudi cuts to oil production. I said, I don't know, that looks weak to me. And I got a lot of pushback on that. And we weren't confident enough to put capital to work there, by the way. It was just part of our macro view. But I said, I don't know, if you put a gun to my head and I had to make a call here, I think I'd be on the bearish side. And then when the Israel-Hamas war breaks out last week again, people, and we talked about oil prices last week, how it looked like they were marching to 100 and then came right back down to 80, 82. You got a 4 to 5% spike in that first day of trading after the war, after markets opened again. We're recording on Wednesday, so maybe by the time this publishes, I'm going to look bad, but oil down 2.5% today. We're now around 83, getting closer to 82 and where we were before the war started. Now, we had Kamran on earlier this week where we talked about Iran and Saudi Arabia, Turkey, and all the regional possibilities for a broader conflagration. And I'm not sounding the all clear by any means, but I'm just pointing out, we have the worst violence between Israelis and Palestinians since 1948, and concerns about, is Iran involved? Is this going to affect, oil prices in general and oil production? And oil, 3-4 days into the war, is shrugging its shoulders. So there's that. There's a lot of interesting developments around natural gas. You've probably seen ExxonMobil ponying up to buy Pioneer Energy at an 18% premium. One of the biggest shale. I think they are the biggest shale producer. I don't know. One of the biggest shale producers. I can't be wrong if I say one of. Nice little way to squeeze around that. You have France and Germany, where Macron and Scholz had a meeting. By the way, if you go to Politico, the picture that they had of the meeting was Scholz and Macron and his wife like stuffing sandwiches into their mouths. I don't know if Politico is saying something there, if they just want them to look bad, but I don't know. I wouldn't want somebody showing a picture of me stuffing a sandwich into my mouth in a story about how I can't agree with, my most important neighbor about energy policy. The issue here is that France wants nuclear to be part of the EU's clean energy future, and Germany doesn't, because Germany is worried that any subsidies that go to nuclear is going to get away from wind and solar, and maybe hydrogen also, which is the things that they care about. So there's that. And then also, a pipeline plus telecoms cable sabotage in Finland and Estonia, where we don't have a ton of details there. We can speculate maybe a little if you want. But all of that conspiring to, for a third consecutive month, natural gas trying to break out from its current range. And we have been very bullish natural gas for the last couple of months. But I know that you also want to go at some of the supply numbers, and maybe you want to pick apart any of those other developments. But I thought we would just check in on energy generally, because for a second consecutive week, things not operating quite the way markets are expecting.
There's a lot to go into there. Let's start with oil. From a trading perspective, and we don't have any position here, just to be clear, one of the adages of trading is when there's fundamental news that should be really good for something and the price doesn't really respond, that's pretty bearish, and you should be worried if you own that asset. And I think that definitely applies in this case. Oil markets definitely don't appear to be pricing in some scenario of greater conflagration. The other thing to note just on oil is, I know you mentioned in your solo podcast, which was excellent, how comparisons to 1973 are just so off the mark, and you really shouldn't compare this to anything. Among other things, just from a purely oil market standpoint, one of the key themes back at that time has been totally flipped around, because if you remember, like, OPEC emerged during that period. That was a period where U.S. was losing energy sovereignty, where emerging markets, where the Middle East was emerging and taking over the oil assets and seizing that power for themselves and starting to hold the U.S. and other Western countries over a barrel, no pun intended. This is the opposite case. You just saw Exxon just bought Pioneer. The amount of sort of latent capacity in the U.S. is huge. And the situation is completely reversed. We are independent of Middle Eastern oil. In fact, I just saw a piece run across the Bloomberg screen, just for a little anecdote. One of these little, brief headline things that said, Saudi tried to increase oil prices to refiners in Europe, and as a result, they bought less from Saudi and bought more from other sources in the last, month or whatever. So yeah, I don't think that those comparisons are particularly apt, and I am, just reiterating that that's not a good thing for oil if you get a Israel-Palestine war and it sort of shrugs. The France-Germany nuclear and green thing, I mean, that's a whole topic in itself. I'm not sure where exactly to start there, other than, maybe you can tell us, you've just done your deep dive on Germany. What do you make of this sort of, I don't want to use the word intransigence, but it's kind of intransigence by the Germans, who don't seem to be in a particularly strong position. Does this sort of show that how weak the German government, the German alliance is between the Greens and the FDP and the center left, where they have to kind of kowtow to the anti-nuclear parts of that group? Or what do you make of that, just from a German standpoint politically?
Yeah, and I forgot. We're probably publishing the Germany thing next week, if not this week, or did we already publish it? Did I miss it in the?
I emailed it out to all the clients, but I didn't post it on the. I forgot
on the platform yet. Yeah. Oh, you forgot. Well, there's the reminder.
Yeah.
But we had a podcast about sort of Germany's economic future with a guy who was very, very bearish about Germany economically. My take in the end, after doing the research, and you'll have to sign up for the Knowledge Platform if you want the full report, was much more nuanced and really can't be. There's no sort of one sentence takeaway. It was, for some sectors really bad, for some sectors not so bad. But the one thing I kept coming back to was that German politics right now, like, Germany needs to make some really hard policy decisions, and this German government is not going to be the one that makes the hard policy decisions. They don't have the imagination to do it. They have hemorrhaged so much support in the polls that they don't have the credibility to do it. And it's this unholy coalition between the Greens and the FDP and Olaf Scholz party, like the SDP. Like they're not on the same page ideologically either. So it's not going to be this sort of thing like the Hartz reforms in 05 and 06, where they go after the welfare state and they start streamlining things and they make some tough decisions, and suddenly Germany is off to the races. It's more like the Schroeder government, which ironically was the one that wanted to push through the phase out for nuclear. So for me, I don't want to go after Scholz. It's a difficult job being the leader of any country, and I don't want to just take pot shots at him. Like, I know how it's an incredibly difficult position that he's in, and especially with the lack of support that he has in a government that was the so-called traffic light coalition. But Germany bet wrong. They bet on Russian natural gas. Russia invaded Ukraine. They're moving away from it. They also decided in the late 90s, early 2000s, and they weren't the only European country to do this. Italy was in there too, a couple others who got freaked out about nuclear energy. And I get that reflexively, but I don't know why policymakers would allow themselves to go there, because it's clean and safe. But whatever, that was the decision that they made. It's a democracy. It's their country. They could decide what they want to do with their energy mix. But they made bad bets. And now this idea that no, like, don't do nuclear. Like, we need the subsidies that are going to help our energy situation when you were the ones that made the bad bets. It really comes off tinny to me, because this is the same country that, when the Eurozone had its sovereign debt crisis, was lecturing the Greeks and the Italians and the Portuguese and the Spanish about all their irresponsible debts. The Italian budget deficit thing is already now coming back because they want to spend 4 or 5% budget deficit of GDP next year, and that's technically against the EU rules. But then at the same time, Germany is expecting everybody to go along with them, because they, in their energy situation, they are screwed. I mean, the next year or two is going to be really, really unpleasant from a German energy situation. And if you got a cold winter, or let's say you did get a regional conflict in the Middle East that becomes a larger thing and energy prices really do go to the moon, like, Germany is going to take it really, really badly. So I don't know how to account for that tone deafness. It's obvious what France wants. Like, France has bet big on nuclear, and they want nuclear to be part of the solution, and that makes sense. I don't know why, if your goal is clean energy and energy sovereignty, you're taking energy technologies off the table. If anything, you want to add more and more technologies to the table. So the best explanation I have is just that this German government doesn't have much imagination and doesn't have popular support behind it. And the sooner that Germany has a new and stronger government, the sooner it can get to the really hard things that it's going to need to do from an energy policy perspective. And I just don't think it's this government. You can see that also in some of the regional state elections that they had over the past week. I mean, the conservatives are resurgent, and the AfD is also resurgent too. So cue all the right-wing German Nazi pieces. They're dusting all those off and just updating the date and posting them on the FT and other places as well. So ultimately, the sort of key takeaway, I think, Germany and France have to be on the same page if anything's going to happen with the EU. And I am, we've talked about how I've become a little bit more pessimistic about the EU, and I'm sort of looking towards France and Macron for leadership, because France is indicating, we're talking about major reforms, and we're going to show off this major new platform for changing Europe a little bit come January, February. Nothing is the last gasp. You can always change things, but I find myself really looking towards that moment and seeing whether France can push this through, because I don't think leadership and imagination is coming from Germany right now. It's going to have to come from somewhere else, and just by default, just by lack of options, it's either going to come from Paris or nothing's going to happen.
It seems to cut against this narrative that Germany is in this crisis situation, the deindustrialization narrative, because tying this back to what we were saying about the US before, and hyperinflation, and are the wheels coming off, and if you extrapolate linearly, then in 20 years we're all dead. I would expect, if Germany really were in a crisis, that they would be willing to sacrifice, principles and sacrifice sort of the fear of losing industrial capacity to France in order to get, guaranteed cheaper nuclear energy. Because that seems to be what the hang up is. And it was funny, if you read the article, I don't know if you saw, I forget who it was, I think it was Elizabeth Bourne or someone said, really can you name one German company that has relocated to France? Who, France has a lot of benefits, but you don't want to start a factory here. But anyway, my point is, when you are in a real crisis, that's when you have crisis response. You have a sort of political response to a price incentive, to a market incentive to do something more drastic. And the fact that they're kind of diddling around and worrying about solar versus nuclear subsidies, and that somehow BMW is going to open up a factory in France and not in Germany, shows it can't be all that bad there.
Well, in some ways, the worst, I mean, this is tongue in cheek a little bit, but in some ways, the worst thing that happened to Europe last year was that it was like one of the warmest winters in recorded history, because, Germany in particular, all these governments were ready for the crisis. And then because of the extremely warm weather and because people didn't count natural gas supply as well as we did, they were prepared for this terrible crisis and it didn't happen. And then when you get people all amped up for a crisis and nothing happens, well, then people assume, oh, well, then it's not going to be that big of a deal. Like, we got through it. Everything's going to be fine. And I think it's that way too. Not to get too far into this, this is a hornet's nest that I'm approaching right now. I think COVID in some ways was the same thing. People got all spun up, like lockdowns. Oh my God, we're all going to die. This could be the Spanish flu, things like that. And it was really bad. Like, it was like, I forget what the exact mortality rate, but was significantly worse than the common cold and things like that. But it wasn't the Spanish flu. And it probably didn't warrant shutting down the economies for multiple years. That's not what lockdowns were supposed to do anyway. It was supposed to give breathing room so that you could staff the hospitals so that when the waves come through, anyway, not to go down the route, but I'm just saying there's a psychological aspect there where when you expect a crisis and then the crisis doesn't come, you get a sense of complacency, and the government that was saying, oh my God, this is the crisis, I think also loses a little bit of credibility. So, again, I think the key takeaway here is that Germany is in a very difficult position. This government is not going to lead it to the future. And in terms of deindustrialization, it's a myth. And it's a myth, myths are not wholly untrue. Usually myths have a kernel of truth at them, or they have some kind of lesson or something that you're supposed to learn from them. And that is a little bit true. Some German companies are lowering production or looking at factories in China or moving factories to Eastern Europe where things are cheaper. It's also probably why Germany's looking at Ukraine and salivating and things like that. But the idea that German industry is just going to leave entirely, that's a myth. That's not actually happening. It's, energy prices plus this, plus that is putting pressure on it. It's going to be less, and maybe the supply chains go here. But like I said, that's not a sexy headline. That's well, now we have to read the data and actually, get into depth. That's not the one sentence headline, Germany deindustrializing. There's a disconnect there between those things. So I'm actually quite bearish about Germany over the next year or two. I'm a little more optimistic that, Germany has reached moments of crisis before. And usually when it reaches moments of crisis, Germany is one of the rare countries in the world that has enough social discipline to be up to task, to deal with the crisis. They've done it, 2 times since World War II, and maybe they'll do it a 3rd time. I would sort of put my money there. But in the short term, from an energy situation, Germany is screwed. Their political situation is not good. And I think you're seeing that in the Scholz and Macron meeting in general.
Well, it's the darkest before the dawn theory of macro cycles, which is, as you say, the really hard and difficult policy changes only happen when there's a sense of crisis. And you need to find these countries where they do have the social cohesion and the political mechanisms that can actually respond to these things and not just spiral from crisis into worse crisis, that they can fix them. And the U.S. is like that, and Germany is like that. So, as you say, short-term negative, long-term, pretty good.
Long-term opportunity, because if the multipolarity and nearshoring and reshoring, if all of that is true, then the countries and companies that still have expertise in making things in living memory, Like, they're the only ones that can give you autonomy and the ability to produce these things. Maybe it'll be more expensive. Maybe they're going to need subsidies. Maybe they're going to need support and things like that. But like, the U.S. has lost way more jobs and way more technical know-how than Germany has. Germany, yes, has I think manufacturing as a share of GDP has gone down over the last 10 or 15 years. It's still much higher than the rest of the OECD. I'm pretty sure I have that figure right. So yeah, it's just a more complicated take, even if in the short term things are not good. Anything else on? We talked about the Finland-Estonia pipeline thing. There's really not a ton of information out there about it. I will just say, and I put this on the knowledge platform, the thing that stuck out to me there was it wasn't just a pipeline, it was also a subsea cable. And people talk about, I talk about subsea cables. I have a lovely map of where subsea cables are in the world and how this could be a major tripwire if you had a regional war cutting the cables. It's why so much emphasis is going towards space and satellites. Can you make sure that communications for your military or for your government continue in case somebody does cut a subsea cable or somebody knocks out, regional networks and things like that? And I think one of the reasons it hasn't happened yet is because it's sort of like a nuclear weapon, mutually assured destruction type phenomenon. If you start going after the cable, somebody's going to do it to you. And, we live in a world where we can't live without the internet. It's sort of like a Fight Club scenario type thing. But I did just want to flag, it wasn't just the pipeline. It was the subsea cable thing stuck out to me a little bit as something concerning. And we'll just have to see kind of what Finland and Estonia share after their investigation is done about who was behind it and why they did it. Because right now, we can speculate all we want, but there's really not a lot of info out there.
Yeah, I guess all I would add to that is it's definitely worth watching, because that would be a huge risk factor if people start targeting them. And one of the choke points that I think is worth watching, I mentioned to you, I read in the last week, there was a piece here pointing out in the media here in France how Marseille is the number one choke point for all cables coming into Europe. And I don't have it in front of me, but there was a wonderful map showing all of the cables coming from Asia, from sub-Saharan Africa and through the Middle East. Almost all of them are coming through Marseille, which thankfully is the most stable and secure city in Europe. But when you think about choke points and things to monitor, that's one that I would put on my, I would put it as a 3 on the importance score in knowledge platform terms, but definitely on the choke point lists to watch if people are going to start attacking these things.
Yeah. All right. Well, I think that's plenty enough of us. Anything else you want to say to the listeners before we sign off, Rob?
I don't think so.
Okay. Well, go enjoy your Downton Abbey, and until next time. Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.